Welcome back to Happy Half Hour, July version. That's Toby Weber. I'm Nik Schuurmans. We're talking about current events, markets. Just when you thought you had it figured out, there's a wrench, there's a curveball. This might be the weirdest environment outside of COVID in my career. Do you agree or disagree with that?
I agree. And who said that we had it figured out? Did somebody say we had
No
it
one,
figured
but
out?
it's just, as soon as you get into a rhythm and you start to settle in almost, summer doldrums, you get a ceasefire that ends, you get a new Fed chair, you get the AI complex, which is now, that concentration risk is leaking to the rest of the world. I don't know if you saw the emerging market index, it's about 40% in 3 companies.
Mm-hmm.
So there's just a lot going on, and there's always a lot going on in markets. I always joke with folks that say, oh, there's a lot of uncertainty out there. Well, is there ever a time there's certainty? Markets say, okay, buy this index, it's a license to print money. That doesn't happen. It just feels like there's a lot of inflection points right now.
Yeah, usually when there's uncertainty in the market, though, the market doesn't do great. The more uncertainty, the more the market maybe struggles a little bit. So it's been interesting to see the market holding up really well, even though there continues to be pockets of uncertainty.
You said you wanted me to pick a number between 1 and 5. Were you being
I
serious?
have some interesting stats that I've pulled over the last few weeks, and so if you want to give me a number between 1 and 5, I'll share the stat, and then you can tell me how you interpret that.
If I agree or disagree, or
Sure.
just how I interpret it?
Sure.
Okay, let's go 1.
Okay. What do the following stocks have in common? Costco, Microsoft, McDonald's, Hershey, Oracle, Adobe, Disney, Netflix, Chipotle, PayPal, Nike.
I was going to say they're down a boatload, but I know that's not true for some of those names. They all have a price to earnings ratio over 25.
No, they're all at or near their 52-week low.
Okay.
So even though the market is near the all-time high, some pretty reputable names are kind of, on their ears, so to speak. You take anything from that?
No, but I'll counter that with another factoid that I just pulled. The Mag 7 is wildly trailing the S&P 500,
Mm-hmm.
which is something that we've been talking about for a while, how most prospective client portfolios just over-own tech stocks. And you have folks that just extrapolate what's happened well into the future, and you can get into size, you can get into just being a known crowded trade, you can get into whatever reason, the CapEx, but a stock going up by 30 or 40% is just unsustainable, and it's really hard to get someone to change course when what they've done has worked. But I think you're starting to see a rotation going on in markets where there's a pretty big gap between the winners and the losers, and unfortunately most people just look at what's worked and they shovel money into those themes.
Yeah, no, I think that's right. And usually when they're large companies, that's what is always amazing to me. You have, multiple $100 billion companies that'll go up 20, 30, 40% in a relatively short period of time. So it isn't a small company that explodes. It's an already huge company that tacks on market value that is just, ridiculous. So I just thought that was interesting that some well-known names, some market leaders, Microsoft, Costco have been kind of market leaders the last 5 years. Those companies aren't doing as well, while the AI and specifically semiconductors is really carrying the flag for the market at this point.
Well, and to your point, some of these large mega companies and the intraday swings for some of these names, again, these are not startup companies. These are not opaque names. These are multi-trillion-dollar enterprises that are up and down 4% from Monday to Tuesday. That's a wild mispricing, if you will, or repricing, and it kind of boggles the mind sometimes.
Yeah, another factoid that I came up with or found was that there's different factors that are at play in the market, and quality is a factor, profitability is a factor, momentum is a factor.
Mm-hmm.
And over the last 50 to 60 years, quality and profitability, mostly profitability, have dictated where the market went. Profitability was up, the market went up. If profitability was down, the market went down. Today, quality and profitability are significantly underperforming momentum.
You're right.
So momentum is carrying the market, which, to your point, people are buying what's worked, people are buying the things that have gone up, and less concerned about the fundamentals, less concerned about, quality and profitability.
And for our listeners that don't know what momentum might be, it simply means what's gone up is going to keep going up.
Yep. Okay.
Number two.
Number two. From 2022 until now, over the last 100 years, if you looked at 4-year rolling returns, what percentile is 2022 to 2026 in that rolling 4-year returns over the last 100 years?
It's got to be in the 99.9%.
That's why you're CIO. You're absolutely right. It's in the 99th percentile, top 1% of 4-year returns over the last 4 years. Is that interesting, meaningful, just the way the data fell out? How do you interpret that?
Well, as you know, I'm a student of history, and I think you are too. And a lot of investing is not rocket science, especially when you zoom out and look at themes. Now, timing can be fleeting, but when I hear something like that, it tells me the next 4 years are going to be more challenging. And it's as simple as that. Markets don't just perpetually go higher. I say this a lot, but I'm hearing more people obsess and talk about performance with zero regard for risk management. And that's one of the flashing yellow lights internally, just the sentiment, the delusional expectations. Hey, if I'm not performing in line with the market, it's all about performance. It's like, no. You have to understand how much risk that you're taking and take known risk and understand the range of outcomes. You can't talk about performance without talking about risk. So to answer your question, if I'm a betting man, I would say the next 4 years, you can even expand that the next 10 years, because the last 12 years has really been the golden generation for U.S. large cap investors. The next 10 years are probably going to be more challenging.
Yeah, and I think you've said a number of times that the time to assess the risk you're taking, the time to understand the risk you're taking is now when things are good. It isn't wait till the market goes down 5, 10, 20%. And then figure out, oh shoot, I was taking more risk than I should have, or more risk than I was comfortable taking. So it's a good reminder that we should be constantly reviewing the portfolio as we do to make sure that clients aren't getting out over their skis, or the portfolio isn't drifting, and all of a sudden we're hanging out there with more risk than we should.
And I'll even take it a step further. The next 4 years, the next 10 years, what's worked over the past 4 to 10 years, technology, AIs, semiconductors, is probably not going to work as well. So there's often a rotation into what hasn't worked becomes what works, and then what's worked becomes out of favor. That's followed every pattern in market history.
Okay, you got something there. Otherwise, I can keep going, but you could look like you got a page of notes there.
What's something, and this might be an odd question, but is there anything that you see in today's markets that just doesn't make sense to you, that you're like, man, that just doesn't feel right, or I don't see how this is sustainable?
Yeah, I mean, it's real easy to say the build out of AI data centers. It just doesn't feel like these. Well, let me back up. The amount of money that's being spent to build out these data centers is astronomical. We've talked about it before. It's hundreds of billions of dollars a year currently. Now, the companies doing the spending were companies that were generating huge amounts of cash flow. So not a big deal. I'm just going to take that cash flow and reinvest it into AI and data centers. Now some of those companies are having to borrow or choosing to borrow money to fund that spending, which tells me that that spending can't go on forever, because at some point, if they don't demonstrate a return, they're not going to want to borrow to the point that it impacts, the overall business. And I don't know if that's another year or two, or if that's 5 years, but the spending that's going on today for AI and data centers, in my mind, is unsustainable.
Well, and every CapEx cycle follows a similar path too. There's this rush, demand's surging for AI compute and,
Sure.
and infrastructure. These projects are not 1 month out projects. These are multi-year cycles. So you invest, you build capacity, you create excess supply, demand goes away, and then there's a huge bust or resetting. And I wrote a piece, 6 months ago, how the early, like every CapEx cycle, whether you're talking railroads or energy infrastructure or telecom, the early investors, the early CapEx spenders aren't necessarily the winners. It's the ones that come, it's the second wave that comes in and capitalizes on the existing infrastructure and can learn from the mistakes of the early adopters. So that causes some pause. My whole deal with the AI thing is, sure, you can get in Excel and you can model these rosy projections, which you can argue are priced into current equity prices, but it's tough to model the human component. There's some things that are popping up that make me scratch my head. A lot of communities and states are pushing back against data centers. They're pushing back against the water usage, the electricity surge, or their pricing of their electric bills. I'm not sure if you caught this, but the CEO of Google was booed off the stage during a commencement speech. Young people are pushing back against AI. Why would you embrace something that's going to take away an entry-level job? So I have more questions than answers. I think about the AI question a lot. To me, it is the question because 55% of the S&P 500 is tied up in the AI trade complex, right? It's either infrastructure, data centers, hyperscalers. It's all tied in there. So there's a lot riding on this. People ask me where the market goes in the next year or whatever. No one can answer that question. The right question is, how does this AI thing play out? And anyone that says they have an answer is full of it, because the range of outcomes is extremely wide.
Yeah, and it is real. I mean, the actual spending going on today is real. You see it in places that maybe you don't expect, like a Caterpillar. Caterpillar's seen their stock go through the roof. Caterpillar does kind of boring old construction. But guess what? Data centers need to be built, and Caterpillar stock has tripled over the past couple of years. I have a client who has a business that supplies construction equipment in the Bay Area, and one of their products is ladders. And he said they can't get enough ladders because the demand in Silicon Valley and surrounding areas down there is through the roof. They can't get enough ladders. So it's real spending, which is, helping boost earnings. You can't deny that. The question is, how long does it go on? How sustainable is it? Who are going to be the winners and losers? And to your point, that has yet to play out.
And right now, most companies in the AI complex are trading like winners.
Yeah.
Okay, I have another question.
Okay.
What do you say to a client that is just in love with the stock? We don't have to name any stocks, but just in love with the stock. They might be retired, they might be living off their portfolio, and they have a position that's over 10%, over 20% of their investable assets. Like, how do you handle that?
Well, I like it when people are engaged and interested in the stock market, and if they choose to express that in buying a stock or 2 or 5, that's great. I think that's great. I think the key is keeping it sized appropriately. So I was with you till you said 10, 20%.
Yeah.
And then now there's probably a story behind it. Either they work there or they bought it 15 years ago and have seen it go up exponentially. In those cases, I'm looking to see if it's going to be an impact on their overall financial picture. And I'm always a diversification advocate. So if someone has 20% in a stock, let's figure out what the right number is. and let's work towards that number as opposed to just letting it go and having it fluctuate and dominate their portfolio. So I like it when people invest in stocks. I just want to make sure that we've sized it appropriately so it doesn't whipsaw their entire portfolio.
That's a good answer.
How do you approach it?
To me, for one, I think investing should be boring. Investing should not be exciting. It's not a casino. It's not a game. It's not entertainment, despite the gamification of investing apps and what you read on social media. Investing should not be exciting. If you're excited about a stock, that's probably a red flag, and you should size it appropriately, which is small, relative to your investable asset base. But I think there's some important questions to ask yourself if you're getting worked up or you want to over allocate to a stock. You need to ask yourself, how could I be wrong? What other people that might think differently than me or think the opposite of me, what is their thesis? Because every time you buy an individual stock, someone who's very, very smart has the opposite viewpoint. You want to understand their viewpoint better than they do. If you have any biases, where is my biases? Where is my blind spots? How could I be wrong? How could this go wrong? Once you go through that process, I think the answer to the sizing question becomes more clear.
No, I think that's right. And we've seen a large number of examples where people bought a stock 5, 10, 15 years ago, and the stock has gone 10x or more. So sometimes people, just by their inaction, have done fantastic, but now it represents such a large part of their portfolio, it probably needs to be managed and kind of managed to the right size for where they are at today. So.
Okay, well, let's go with number 5. You thought I was going to go in order.
Number 5, maybe the stock market can be boiled down to this statement: liquidity rules everything. Maybe fundamentals don't matter, maybe technicals don't matter. All we should be looking at is the Fed and others, are they increasing liquidity in the market, or are they withdrawing liquidity from the market? And if they're increasing it, you want to be invested in the stock market because over time it's going to go higher. Maybe it's just that simple.
Well, there's this old saying that exists for a reason: don't fight the Fed. And I think there's a lot of truth to that. And look, over the past 12 years, we talked about the golden decade for US large caps. Money was relatively cheap. Aside from 2022, money was sloshing around. The Fed was expanding their balance sheet. Banks were flush with cash that they wanted to lend. That's a loose liquidity environment where money is readily available, capital's cheap. If you believe what the new Fed chairman is saying, he wants to shrink the balance sheet. I don't know what that looks like. It might be too soon to tell. I pointed out in a blog a few weeks ago that oftentimes when the Fed chair turns over, when there's these inflection points around should we hike rates, should we cut rates, which expectations are all over the map now, there often can be a market drawdown in that type of environment. So in general, I would agree with you. Liquidity does tend to drive prices, and that just makes sense. When capital's cheap, when folks can borrow and invest, markets tend to move higher because that flows through the economy, which flows through to earnings. When money's tighter, like when rates went from essentially 0 to 1% to 4 or 5% back in 2022, that shocks the system. Capital's more expensive. It's harder to come by. It's not an accident that the S&P 500 was down by 20% in 2022. So don't fight the Fed. That's a mental shortcut that actually has stood the test of time.
Yeah, and I think liquidity can also have an impact on inflation, can also have an impact on the US dollar. So there's all sorts of knock-on effects of having more liquidity in the system versus less liquidity in the system. And right now, since the end of last year, we're in a period where more liquidity is available. You could argue that's helped put a floor under stock prices despite the war and despite everything else going on. But I always come back to that and think, maybe it's just that simple. Okay, what do you got one there? Or?
Let's go with number 4.
Okay. This is more of a statement and then you can respond to it, but I was doing some performance attribution analysis, which is a word salad, which basically means I was trying to figure out why the market's gone up and what areas of the market have gone up and what areas have gone down. Value stocks in 2026 have performed quite well. Small cap value is one of the leading areas of the market, asset classes of the market. It's up 15-18% so far this year. Large cap US value has also outperformed growth stocks. I thought that was interesting. So then I drilled into the top performers in large cap value. 2 of the top 5 stocks in large cap value that have driven the returns this year are Micron and Intel. Those are 2 of the top 5 value names. I found that interesting because you think value, I'm thinking Hormel Foods, Campbell's Soup,
Right.
Companies that generate cash flow but aren't the most exciting businesses and aren't growing leaps and bounds. Micron and Intel being 2 of the top value stocks this year was interesting to me.
Well, and you probably know where I'm going with this, but the forward PE for Micron is quite it's in like
7.
mid-single digits or something like that. And if you, not to get in, I'm not a memory expert,
Sure.
but the whole memory cycle. So a lot of these AI models need compute, they need memory. And memory, like we've dug into this a bit, but it goes through boom bust cycles, and it's the same CapEx cycle. Like demand goes way through the roof, memory prices go up, there's all this new supply coming on board, and then demand disappears and there's a huge bust. Some are saying this is different, which I'm always
Leery of.
taken aback when
Sure.
I hear that, but certainly Micron, SK Hynix, SanDisk, some of these big memory companies have seen just blowout earnings, and supply can come nowhere close to meeting demand. Hence, why Micron really can be classified as a value stock, even though a traditional growth investor might push back on that.
Yeah, it's from what I've read, its supply of memory is so tight
Yep.
that prices have gone up and up and up as they do in the cycle. Micron's margins in the most recent quarter were 86%. So that would tell you we're probably at the top of the cycle. As more supply becomes available, or if we get a pullback in demand, it wouldn't be surprising to see that go the other way. For reference, Micron, has gone from $300 or $400 a share. I think it peaked at $1,100 a share, and today it's a little under $1,000 a share. And you might think I'm talking about the last 5 years. I'm talking about the last 5 months. So
Right.
at the end of March, it was $300-400 a share, and then spiked from there. Intel had a similar experience. Intel's kind of been on its ear for the last 10-15 years, and the stock has gone from $35 a share, peaked at 130, and has kind of pulled back to 105, 110 today. So again, these are not multi-year moves. These are 4, 5, 6 month moves. So kind of interesting to see that that's what's driving value stocks currently.
And we should put a caveat in here. We're talking about a lot of individual stocks here, which we're not advocating that you buy any of these. We're using this as an anecdotal example of what we're seeing in the market. So for compliance, for listeners, don't go out and buy these stocks. We're not advocating for them. We're just using them as an example with what's going on in the broader market.
Correct. None of this should be considered investment advice or a recommendation.
Okay, let's hit your last one, number 3, I believe, and then we'll wrap this up.
Okay. The last one I had on my list, we always, not always, periodically we'll give an update on Bitcoin, an update on gold. They've been fairly active this year, not necessarily in the positive direction. What are your thoughts when you look at Bitcoin and or gold today? And then I'll chime in.
So the question that I asked you earlier, what is confounding to you about this market or doesn't feel right? Some of the movements in Bitcoin and gold are just absolutely wild. Like today, they're up quite a bit. Most people, so let's start with gold. Most people think about the historical role of gold and how it reacts to certain economic indicators. So gold historically is a good inflation hedge. Well, when the war broke out, inflation was biased to the higher side because of energy prices, but gold went down. Okay, so that is probably the biggest confounding move. Anytime the Middle East conflict flares up, gold really takes a hit. I'm not sure if you've noticed that.
Yes.
And again, that goes counter to how it's traditionally thought of in a portfolio. And Bitcoin, I think we kind of touched on this last month, but a lot of Bitcoin, especially now that that retail investors have access via an ETF, I think some of the moves might be more violent, and a lot of the Bitcoin hot money, quote unquote, has really flowed into the AI complex names, as that's really in vogue. So gold moving without rhyme or reason, it really has defied how one would traditionally think about gold. When inflation goes higher, when the Middle East conflict breaks out, gold's gone down. It's had some wild moves in 2026, going from up, I think, 30% in January to down 5% today. I think I've tried to trim gold across our client portfolios just because it's had such a huge run. It was up 60% last year. So if our target is 10% gold in a portfolio, all of a sudden it might be 14 or 15%, just how far it's moved. So I think moving back to neutral, rebalancing to target weights, and then the Bitcoin question, again, Bitcoin has become more of a thematic trade, it feels like, given the introduction to ETFs and access to retail investors. Bitcoin's been out of favor just because the AI complex has been so in vogue. So I still believe the long-term thesis for both are intact when you look at the debasement of the dollar, loss of purchasing power, all these fiscal and monetary policy experiments. I believe the long-term thesis is still intact for both gold and Bitcoin, but in the short term, they can move without rhyme or reason.
Yeah, I would chime in with a couple of thoughts. One, who knows if this logic is correct, but people have said that with the war and with energy prices going up, there's a lot of central banks out there that were buying gold and now are selling gold to pay for increased energy costs. That seems plausible. Don't know if that's the key reason. The other thing I would say is that gold has a mind of its own. Trying to predict the movements of gold historically has been a fool's errand. It probably, in some respects, kind of got ahead of itself last year, being up over 60% last year. To Nick's point, was up another 25% in January, and today sits at negative 5%, I think, year to date. So it's at quite a retracement lower. And the last thing I'll say is, I'm kind of this whole momentum concept, and the whole that there's money, a pocket of money, that call it hot money or whatever you want to call it, that kind of moves to where what's working. And last year, at the end of the year and beginning of this year, gold was the place to be. So you probably saw some element of hot money there. Now it's on the AI side. At one point in the last year and a half, 2 years, it was on Bitcoin. Mm-hmm. So it just kind of seems like it moves around and causes prices to spike, and then when that money moves on, prices kind of normalize back down. So, but it's definitely been an interesting stretch with both Bitcoin and gold both up and down.
Okay, I guess we will leave it there. 30 minutes, happy half hour, can't go longer than that. That's Toby Weber, I'm Nik Schuurmans. We'll see you next month. If you have any questions about how we work with clients, how we run our quantitative investment process, feel free to shoot us a note at lakeoswego@waverlyadvisors.com. We'll try to put that in the ending slide here. All right, we'll see you next month.
Cheers.